Namaste. In this video, we are going to discuss about IND S1 that talks about the presentation of financial statements. Objective of IND S1 is to prescribe basis for presentation of financial statements to ensure comparability. Comparability between the financial statement of same entity with the previous periods and comparability among the financial statements of different entities. Apart from it, it prescribes and set out overall guidelines for presentation of financial statements. Guidelines in respect of the structure of financial statements. Apart from it, it prescribes minimum requirement of the financial statements. It prescribes minimum line items which need to be presented on the face of various statements that are part of financial statements. Here we need to remember that IND S1 does not prescribe any format for preparation of financial statement. It just prescribes the minimum requirement that should be presented. Here, Schedule 3 to the Companies Act 2013 comes in the picture. That we will discuss in later video. Financial statements are the structured representation of financial position and financial performance of any entity. So to provide the information to the end user, India suggests that we need to provide the information regarding the financial position of the entity, that is balance sheet, regarding the financial performance in respect of profit and loss and statement of change in equity, and the statement of cash flow to the users. Apart from it, we need to present the notes that should comprise the accounting policies, other information, and explanatory notes in respect of the financial statements presented, and it should have the comparative information also for the period we are going to present financial statements. Let's discuss about the general features of financial statements. Financial statements shall present a true and fair view of financial position, financial performance, and cash flow of an entity. And this true and fair view depends upon the faithful representation of the effect of transactions, other events, and conditions in accordance with the definitions and recognition criteria that is defined in conceptual framework for financial reporting under Indian accounting standards. So our assets, liabilities, income, and expense related transactions should be recognized and should be classified according to the definition and principles given in the conceptual framework. So when an entity is issuing financial statements and it has complied with the requirement of Indian accounting standards, in that case, that entity should make an explicit and unreserved statement of such compliance in the notes. An entity should not describe financial statement as complying with IND AS unless they comply with the all requirement of Indian accounting standards. So we need to understand that this statement of full compliance of Indian accounting standards is extremely important in IND AS regime. If an entity that does not include the statement of compliance in its financial statement, it would render the whole financial statements as non-compliant. This is despite the fact that except for the inclusion of this statement, the financial statements were otherwise fully compliant with Indian accounting standards. So we need to understand this concept very, very carefully. An entity shall present its financial statement based on the going concern concept. Unless management is of view to liquidate the entity, it is going to cease the trading, and there is no realistic alternative to do so. So if there is an uncertainty regarding the going concern of the entity, in that case financial statements of the entity will be presented and prepared based on the going concern concept only. Only in case of certainty that company going concern is not going to be exist, only in that case entity will depart from the going concern concept. And in case of departure, entity shall disclose the fact and basis on which the financial statements are prepared and reason for not being going concern. These two facts will be disclosed by the entity. And its financial statements will be prepared based on the accrual basis except for the cash flow information. Next is materiality and aggregation. A new definition of materiality has been recently added and it is applicable since April 2020. And according to this definition, an information is material if omitting or misstating or obscuring any information is going to affect the decisions of financial statement users. In this case, this amendment specifies that materiality will depend on the nature and magnitude of the information, and an entity need to assess whether information individually or in combination with other information is going to be material or whether it is going to affect the decisions of the end user of financial statements. And new concept in this amendment has been brought, that is obscuring. So an information will be supposed to be obscure if it has same effect as omission or misstating of the information. For example, a material item, transaction or other event is scattered throughout the financial statement will be called obscuring. Another example, if something is disclosed that is disclosed in such a language that is vague or unclear will be considered obscuring of the information. Next is, there are so many requirements of the Indian accounting standards where we have to present the information in the notes. In that case, we are supposed to present these information in the notes only if they are material or if they are required by the law. If the informations to be presented are not classified to be a material information, we are not supposed to disclose all the information in the notes of the accounts. Next is offsetting. An entity shall not offset assets and liabilities or income or expenditure unless it is required by or allowed by Indian accounting standards. And in this case, the reserve for inventory valuation or reserve for doubtful debts is not considered as offsetting, so it can be presented accordingly. Apart from it, next is frequency of the reporting, and this frequency should be at least for a period of 1 year. If entity is not going to present for 1 to present for a period, in that case it will present the reason for being do so and the fact that amount presented in the financial statements are not for complete year and are not comparable in that case. Apart from it, next is there should be comparative informations. Those are presented in the financial statements, and there should be consistency in presentation and classifications of items in financial statements from one period to another period. So these are the general features of the financial statement. Structure and content of financial statements. So in the structure, entity will present the name of the reporting entity, whether the financial statements are for the standalone or for the group of the entity, it has to be presented, and the date of the end of the reporting period for which financial statements are presented, or the period covered by the set of the financial statements. Apart from it, it will present the currency in which financial statements are prepared and the level of rounding used in presenting the amounts in the financial statements. So these all things will part of the structure and content. Ind AS 1 prescribe following items to be presented in financial statements. As we have discussed earlier, that this standard does not prescribe the order or format in which an entity need to present the items. An entity may present additional items and can make judgment for that on the basis of the nature and liquidity of the asset, the function of the asset within the entity, and the amount and nature or timing of the liabilities, etc. Apart from it, one thing we need to note that there is a difference between the cash and cash equivalent as per Ind AS 1 and as per the definition of Ind AS 7 cash flow. So that we will discuss later on. Apart from it, all these classifications need to be further classified in current and non-current category apart from the deferred tax assets and liabilities. So we will briefly discuss current and non-current concept. If entity expect to realize the asset or settle the liability or intend to sell, consume in its normal operating cycle, it will be classified as current. And if it is being held for the purpose of trading, or if it expect to realize or settle within the 12 months after the reporting period, or cash equivalent unless restricted for exchange or for settlement, will be classified as current assets or liability. So this is all about the Ind AS 1, the brief summary that we have discussed. And if you want to know more and need to discuss something, you can contact on the WhatsApp number given on the screen. And let's discuss another video, another topic. Namaste.